Inventory turnover ratio is a metric that calculates how many times a retail business turns its inventory in a year. It's used to track how efficiently a business is managing its inventory. If the business invests an initial amount in inventory, every time it turns this inventory, it generates profit out of it. Turns here means sells and replaces the inventory with new one. The formula for inventory turnover is COGS divided by average inventory at cost value. To get average inventory, you simply take the beginning inventory at cost value and add it to the ending inventory or closing inventory at cost value, and then divide by 2 to get the average. Now, some of you might ask, how can I calculate the average inventory if the business only reports the closing inventory? For example, when you look at the balance sheet of a public company, you will find that they report closing inventory in the assets. You simply get the beginning inventory of this year by looking at the closing inventory of last year. So you go to the balance sheet of last year and get the closing inventory and use it as a beginning inventory for this year. We should also note here that you want to get the average inventory throughout the year. And the more data points you take, the more accurate the result is going to be. So for example, instead of taking only the beginning inventory and ending inventory, you can actually take the ending inventory of every quarter, so you will have 4 data points and get the average. Or if you run your own business and you have the ending inventory of every month from your open to buy Excel sheet, for example, or from your reports, you take the ending of every month, so you will have 12 data points. So the more data points you have and get the average from, the more accurate it's going to be. So let's see an example and apply the formula. In 2020, Business B has generated a sales volume of $1,459,689 at a gross margin of 45%. By the end of 2020, the closing inventory was at $400,564 at cost value. In 2019, the business had a closing inventory of $375,958. To calculate the average inventory, we will add $375,958 to $400,564 and divide by 2. So we get an average inventory of $388,261. To get COGS, we multiply sales by 45% to get the gross profit, and then minus that amount from sales to get the cost. Or take the shortcut that we explained before and multiply sales by 55%, which is 1 minus 45% margin. Actually, let's do it both ways. So we either multiply 1,459,689 times 0.45, and this gives us 656,860. We then minus this 656,860 from sales, which is 1,459,689. So we get 802,829. Or we can use the shortcut and multiply sales, which is 1,459,689, times 0.55, which is 1 minus 0.45, because the margin was 45%. And this will give us the same amount of 802,829. So that's the COGS amount. Now let's continue with the formula. Inventory turnover equals COGS divided by average inventory, and then we get 2.06. So this business turned its inventory 2.06 times in a year. As we mentioned in the last lesson, this means that the business maintained a forward stock cover of almost 6 months. Another metric that's closely related to inventory turnover is days sales in inventory. Days sales in inventory measures how many days it takes to sell the company's inventory. It's also a metric that measures the efficiency of inventory management process at the business. The formula for days sales in inventory is days sales in inventory equals average inventory at cost divided by COGS and then multiplied by 365. In other words, days sales in inventory equals 365 divided by inventory turnover. Let's apply the formula to the same example we used for inventory turnover. So days sales of inventory equals 388,261 divided by 802,829, then multiplied by 365. This will give us 176.5 days. If you remembered, we said that this business maintains a forward stock cover of almost 6 months. Another important metric when it comes to inventory is the Gmroi, sometimes also referred to as Gmroi, or the gross margin return on investment or return on inventory investment. This metric measures the amount returned on every dollar invested in inventory. For example, if Gmroi equals 3, it means that every dollar invested in inventory returns $3. This metric is used to measure the performance of the business and how efficiently it's able to allocate its buying budget to products that generate higher returns. It can also be used to evaluate different suppliers and vendors based on how much their inventory returns to the business. Based on the evaluation, the purchasing budget can then be reallocated more efficiently by moving invested money from low return categories or SKUs and investing in higher returning ones. The formula for Gmroi is gross profit divided by average inventory at cost. So let's apply this formula to the same example we used previously. We mentioned that in 2020, Business B has generated sales volume of 1,459,689 at a gross margin of 45%. By the end of 2020, the closing inventory level was 400,564 at cost value. In 2019, the business had a closing inventory of 375,958. So gross profit equals 656,860 and Gmroi equals 656,860 divided by 388,261. That's 1.69. So every dollar invested in inventory returned $1.69. Just one insight here. Based on the formula, a company can increase its return on inventory by increasing its gross profit or by reducing its average inventory holding, or in other words, by increasing its inventory turns. So to get back to what we have discussed at the beginning of this section, on how companies should determine their closing stock levels. This is done by analyzing their returns on inventory and determining how many times their ideal inventory turnover should be, and then adjusting their buying to maintain that level of inventory. For example, a company could decide that 4 inventory turns in a year is ideal and in line with the industry benchmark for its retail segment. So it decides to keep their forward stock cover target at 3 months and replace their inventory every 3 months. This forward cover target is then used and monitored in the open-to-buy management process. Also, companies that can turn their inventory faster can still achieve high profits with lower gross margins. For example, you will find that off-price retailers operate with a low gross margin, and the same goes for grocery stores and pharmacies. But because these businesses turn their inventory many times in a year, sometimes even more than 10 times, every time they turn their inventory, they make profit on it and buy it again and profit from it again, and so on. So this is how all those pricing, inventory, and financial metrics are tied together to ensure the best financial returns for the business. Another metric that's used in inventory management is sell-through rate. This metric calculates how much has been sold out of the originally ordered quantity. The formula for sell-through rate is sell-through equals number of units sold divided by number of units ordered and then multiplied by 100 to get the percentage. For example, if you bought 3,000 pieces of a product and by the mid of the season, you have sold 1,390 pieces. Applying the formula, we get sell-through equals 1,390 divided by 3,000 multiplied by 100. This will give us 46.33%. Sell-through rate is used to monitor the inventory and know when to introduce markdowns and when to increase markdown levels on certain products so that they can be cleared by the end of the season. It can also be used to evaluate suppliers and vendors and see how their products are moving without the need of markdowns. A product that doesn't meet its sell-through rate target before the markdown season might be a product that was not suitable for the customers to begin with, or it could be that its pricing was not done correctly. Comparing the different SKUs by sell-through can also guide you on where to direct your future buying budget and where to scale down. It could tell you which products you can increase investment on and either increase their depth or breadth by allocating more money to them. At the core of inventory management is monitoring the aging percentage of the merchandise on hand. Aging percentage is the percentage of stock that's starting to reach a certain age, for example, 6 months and above, and might soon become obsolete or less valuable. The formula for aging inventory is aging percentage equals